Hello, everybody. This is Michael DeJoy with the DAS Newsroom. This is an issue on, has the summer rally, is it set to fizzle? As the summer has heated up, are we ready to fizzle into the end of summer? And I'm joined here today by my co-host, as always. My name is Michael DeJoy, Director of Education. And I'm joined by Jill Molandrino, who's actually in the Nasdaq market site in New York as I travel around Virginia on summer vacation. So Jill, how are you?
Good, doing well, thank you. Would love to switch spots with you.
I'm representing King's Dominion here, and I just went to Busch Gardens, and Virginia is beautiful as always. And we are really in the end of summer, which is the best time to go to King's Dominion and Busch Gardens because all the kids here in Virginia have already gone back to school. But the Northeast has not gone back to school. So, and this actually has a big impact on the markets generally because the Northeast, when the students go back to school in the Northeast is when the market starts to pick up again, which is usually the second week of September. So they go back to school on the first week of September, and then everybody gets back to their trading desks the second week of September, and that's when all the big money starts coming in and out. In fact, because the rest of the country has gone back to school and the Northeast is wrapping up last-minute vacations, which kind of coincide with the biggest vacation time in Europe. So the last 2 weeks in Europe, from August 15th to the end of August, is European vacation time when most of Europe is on vacation. So you have all the big money managers in Europe on holiday. You have all the big money managers in New York on holiday and in Boston. And then of course you got most of the people in the United States going back to school, not paying attention to the markets. So what that does is that makes us have a very, very low volume end of August. It's actually not the lowest volume time of the year, but it's the second lowest volume time of the year. With Christmas and New Year's being the only time of the year that has lower volume than now. And sometimes it's a trade-off. It's the end of August, the end of December, it's one or the other. But we had two big earnings reports this week. In fact, one was today, was Kohl's. So Target and Kohl's, two major US retailers having trouble. And does that illustrate trouble on the horizon? So what are your thoughts on this, and what are the real details related to this kind of retail fizzle?
Yeah, it's so interesting, Mike, because as you and I were talking behind the scenes here, think about market activity from the June lows to where we are now. It's almost as if it was pricing in the Fed becoming more accommodative, which it certainly is not, as inflation, even though the data might have pulled back in, it's still over 8%. And that's what we're seeing translate into reports such as Target and Kohl's. While the first, 80% of earnings that had come out might have been okay, and certainly stocks caught a bid off of that because it was less bad than expected. I mean, the numbers out of Target were just, profits down 90%. And it was blamed squarely on the lack of discretionary spending as consumers are feeling the impact of inflation. So we're certainly not out of the woods yet. We're also coming into a seasonally more volatile time of the year. And, we know how important consumers are to the economy and how that translates into the market. So, it could be a little bit rocky here. But again, Kohl's was another one too, blaming, the lack of consumer discretionary spend. Once it shows and it's translating into numbers, it's one thing to, have the conjecture during Q1 and Q2 when inflation really started ramping up. And now we're actually getting those numbers reported and it's quite clear.
Well, there's two things that I think both Target and Kohl's said in their earnings report was that it was the middle to working class consumer who has tapered their spending. And that's exactly their key demographic. So it's the middle and working class consumer is the most affected by inflation. And the other key inflationary number that was, stood out in my mind was that, that inflation, although it has stopped going up, meaning it is not increasing from 8%, it's still sitting at 8%. So we're at an 8% annual inflation for the year. So even though we have stopped the rapidly rising inflation, it's we're not at hyperinflation anymore, meaning rising inflation, but we have not curtailed inflation. So we've just kind of stopped where we
Mhm.
are, but prices are still rising. It's just not rising any faster than they were before. And I
Right.
think that's a key factor going into the Christmas, the Christmas season, and certainly the back to school time. That really has a huge effect on, back to school is big for Target. It's big for Kohl's. I mean, and that's already, shown. Then the other problem that they cited was that they had massive amounts of inventory that they over purchased. And now they're dumping that over purchase. And, that ends up in the Dollar Trees, that ends up in the dollar stores, that ends up in the odd lots and all these other kind of discount retailers.
Right. Well,
So,
you know what, Mike, I don't, this is just pure conjecture on my part. I don't believe this has been cited in any of the earnings reports or conference call commentary, but you have to remember too, that Amazon did a two days worth of Prime specials, right, over the summer. So why not, get your back to school shopping done there where you don't have to go into the store. The deals are going to be
absolutely.
pretty incredible. I mean, they had record days. So I wonder if there was some fallout from there as well. Nicole specifically cited homeware, and I believe it was either children apparel or toys. Well, that's what people purchase on Amazon Prime days. So I
Absolutely.
wonder if there's some carryover from the actually, maybe not. I think it was in July, August, September. Maybe that wasn't second quarter, but I'll be curious to see if there is an impact when they report Q3.
I would without a doubt think that people just said, what, let me order it online and not have to worry about. I mean, I remember, I don't really do a ton of back to school shopping these days, but I remember that the problem always was that, you're looking for this notebook or that notebook and it's just not there. So, I mean, you do it on Amazon Prime Day and you're going to get it. Somebody's going to have it and it'll hopefully get to your house. So I think that'll definitely have an impact in these kind of major brick and mortar retailers. And certainly it has, because both of them had terrible earnings. Now that brings me to what I brought up earlier. It's the end of August. It's generally the lowest volume time of the year. What does that mean for the remainder of 2022? And really, what does it mean for the next earnings season, Jill, from your perspective? I mean, energy costs have slowed. We have some weird kind of economic news with like Turkey, cutting their interest rates, even though they have something like 80% inflation. I mean, there's a lot of strange geopolitical / international activity going on. What is your outlook going into the end of the year, considering that really the market had a horrible first quarter, pretty bad second quarter, and now we're going into the third quarter and it's kind of had a real nice snapback.
Right.
Is that just a summer doldrum rally, or is this something that is going to have some legs?
I think we're certainly in probably at best more trade range bound than necessarily the spike that we saw in June or July. There's, Q4 has a seasonality, right, with October and November, well, September, October, November, so kind of back half of Q3 as well. We're coming into midterm elections. There's a lot from a macro perspective that's in the back end of the calendar. And then of course, we'll have to see what it looks like with earnings. I mean, you're still, once you get third quarter earnings, and you're still going to see that spike with inflation and with gas prices and so forth. So I don't think in terms of earnings, we're out of the woods yet. Seeing slowdown in profitability and revenue, but it'll be and with any other earnings case, I'll have to listen to what guidance says and what they're saying on the conference calls and what they're saying in the earnings reports, because if management thinks that we are coming out of the woods and they expect 2023 to be a little bit more normalized as it comes to macro factors and with earnings stabilizing, that could be a catalyst. However, you still have the war in Russia, right? They're geopolitically, and not even just around the world, but here, there's any one of these factors could be a market moving event. So if something were to get better or worse, that's certainly going to impact it. But I think, trade range bound at best at least for, the next couple of months, probably makes sense. And I'm sure you're going to talk about it in the charts as well. But, we took a look at the Nasdaq 100 today, and it's hitting, a key level of resistance. So what happens from there will help to set the tone. And I'm sure you'll cover that with your chart.
Absolutely. I'm going to be taking a deep look into the technicals, and the technicals generally state that whatever happens in the beginning of the year tends to happen in the end of the year, and that the summer is kind of like the midday doldrums of the year, which means that we probably have another leg to the downside. And I think the key thing to watch is how deep it goes down. So if it goes down and is less shallow than the prior move down, that would be bullish. If it goes down and is equal to the prior move down, that would be considered neutral, right? Like that's what you would expect it to do. We always say in market technicals, markets don't bottom, they double bottom. But the question is if we go down and we go deeper and we break the lows of the first move down, that would be extremely bearish, and that would be very parallel to 2008, where we had a very big sell-off in the beginning of the year, a very nice bounce going into August. And then, of course, we had a reversal to the downside that broke the low. And then when that low broke, that was where the market kind of fell out of the bottom. And eventually it did level off. I think it was around March of the following year. And I'm not saying that that's going to happen, but that's how you measure something technically, is how it relates to the prior low. And we'll take a look at that in the chart section.
Cool.
As far as earnings, okay, we saw very lackluster earnings for the banks. Some of the banks, specifically, I guess Goldman Sachs, did exceptionally well. So there was a kind of mixed bag for some of the banks. Certainly the retailers took it on the chin. Technology was a mixed bag as well. Certainly airlines had a tough, they had a tough summer. It certainly seems like everybody I speak to these days is either delayed or missing a flight or somehow gotten shifted around the country. So we certainly had all kinds of activity going on, continued supply chain problems. What are the expectations going into the holiday season? What are the expectations for a soft landing? I mean, it seems to me like, everybody's expecting the Fed to taper, but we still see record low unemployment, which I interpret as the Fed going to read that as, let's, hike the rate some more. We're not bringing down inflation yet. So let's whack them all. Every time the economy seems to lift its head up, the Fed's going to whack it down one more time. I mean, that's its job, isn't it?
And it's been clear about that. That's why I think, it's been the term, the most hated rally. It doesn't make any sense. What are we trading off of? Like, what's the discernible fundamental that the market has recovered the way that it has in the past couple of months? The Fed certainly hasn't changed its tune. And to your point earlier, yes, some of the data is less bad than it was in May and June. It's still not good. I mean, the housing market is another one. Sales have significantly slowed. Prices are coming down. I don't think that's a function of interest rates, to be honest with you. I think it's a classic supply and demand issue. So, the macro picture has not changed that dramatically. That would, warrant double-digit moves in 2 months. I'll take it. So, certainly my 401k is happy about the shares that I acquired at better valuations, but I don't think the macro picture has changed that dramatically to warrant a double-digit move. I think the Nasdaq 100 is up 21% in 2 months. Substantial. Yeah,
it's very substantial. Absolutely, it's a ginormous move, really. And actually, I mean, as a trader, you study markets and you study the history of markets and market moves. That would fit into the definition of a bear market rally, which is a very steep and sharp rally that is not backed by fundamental data. And that is my concern. And that's why I would say that the right move for a trader who took some swing long in some core positions would be to lock in some profits here if you are swing and core trading. And, so that's going to bring us to our next section, which is the market analysis. So Jill, thank you so much. I really appreciate it. I hope you're enjoying your summer. I know I am. What's left of it.
Yes, I will talk to you guys in a couple weeks.
Yep. See you in 2 weeks, Jill. And I hope to see you in the market center soon in the very near future. We'll have to
do one of these from here for sure.
Absolutely.
All right. See you guys.
We're jumping to the charts now. So let's jump on to the charts. All righty, so we're gonna jump in here. We got our S&P chart here with our dash trader. I've been sporting the blue background just so that people know that you can change the colors of your background with dash trader. You can dash has a whole bunch of different skins, and one of them is the midnight blue skin. And I got tired of the black as night skin. And you can see that the market has, pretty much done what we call 3 rotations to the upside. I'm going to say that this was kind of the bottoming rotation from here to here. So that would not count as my rotations to the upside, but this was the first one rotation, 2 rotations, 3 rotations. If I were, if I were a betting man, and I don't like to say that when talking about the stock market, I would say that, that this would be a good place to take some profits. You can see the number on the S&P, the key level here at 428. You can see that we've kind of rose into this 428 level. 428 is a very important level of resistance, because you can see, and I'm just going to use our dash traders rectangle tool. So I'm going to click here, you go to rectangle, and what we use the rectangle to is to identify areas of, in this case, resistance. And if you look at this tool, and I'm just going to make it a little bit bigger in a second, you can see that really this is the area that the market kind of gapped down from. So you can see that here is the lows. This was a low. This was the lows. This is the highs of that little bounce. We've kind of stayed in this area. So this area up to this red line, this deep red line, which is called the point of control, that's the area that we need to keep an eye on. That's the area where we need to watch the markets and say, okay, this is probably where the market rally will sell off. I also want you to look at the volume. The volume today was excruciatingly low. And usually that's an indication. So you might get one more squeeze up on low volume, but what usually happens at the end of August is not what you would expect to happen after the end of August, because big players can move markets at the end of August. And if they're still long, they're going to squeeze every last dollar out of it. And this is the S&P. So I'm going to go to the Nasdaq. Let's do the Nasdaq. Nasdaq, you pretty much have the same picture over again. I'm not going to put the rectangle box in there, but you can see with the dotted line that this is an area of resistance. Resistance means a ceiling. And of course, we're going to go into the last one, which is the DIA. Here's the DIA rallying into this level, pretty much here at this level at 340. You got that same kind of area of congestion. This is going to be a huge area of congestion in this. I will use my rectangular tool. Actually, I'm going to use my, let's see. So I'm going to use my rectangle tool here. This is a huge area of resistance. I mean, it would be extremely difficult for the market to traverse this area. I mean, it doesn't even just have resistance from here. It has resistance from back here. So you really have a huge area of resistance. The deeper it gets, the Dow, this is the DIA Dow diamonds, or Dow 30 tracking ETF. The deeper it gets into that area from 340 into 347 or 350, the more sellers you're going to get. So the way this works is that if you bought it at 350 and you're at 340, maybe you're happy with a 10-point loss. But if you get to 350, you're happy to get your money back. So if you did hold it through all that pain and suffering, you're going to sell it when it gets back to even, or at least that's the rationale, the psychological rationale. Now, GBTC is Bitcoin's tracking stock. I mean, Bitcoin really did not rally with the markets as you would expect it to. ETHE, Ethereum probably will rally pretty nicely from here. We have Ethereum 2.0 coming out. ETHE is the Ethereum tracking stock. It's a cryptocurrency fund, and it is a tracking stock, so it's supposed to move with Ethereum, but you can see the bounce in Ethereum was better. GLD, which is gold. Gold made a nice bounce off the lows, but it's kind of pulling in a pullback. Now, if we make a higher low on gold, that would be something interesting to look at. And I would probably be looking at gold if it puts in a higher low. The low that was established was at 158.75 or in that area. And we're now at 163 area. So probably gold will be putting in a higher low. I'm going to take a look at some of the big name stocks like Apple. I mean, Apple just a rocket ship back to the highs. Certainly, I would take a look at Apple. I mean, there has been no bear market in Apple. I mean, we are at the highs. This was an enormous run on Apple. And, you know, very, very incredible run on Apple. Okay. And this is Amazon, also made a tremendous run, putting in kind of a double bottom or a W-shaped bottom on this weekly chart. Amazon really benefited from their split. And certainly, like Joe mentioned, they had a double prime day this summer, trying to angle in on the back to school sales and other summer related items. So certainly Amazon has done well. You got Citigroup, one of the banks that's done pretty well, JPM, you know, kind of coming off their lows. I mean, JP Morgan got really slaughtered in the beginning of the year. You can see on this weekly chart, but very, very interesting. Let's see Goldman Sachs, which was, you know, really one of the most, one of the banks that did really, really incredibly well with their earnings, as you can see back here. Really nice move on Goldman Sachs rather. Morgan Stanley also did very well. So the investment banks benefiting from companies with a lot of cash or a lot of equity in their stock, purchasing out other companies. So there's a lot of M&A activity going on, certainly some trading activity as well. So some of those big banks, especially in the investment banking sector, not the retail banking sector like JP Morgan, have done really, really well. Other companies that I'd like to point out is ExxonMobil. Certainly ExxonMobil benefiting from they were a dog in the big bull market, but now with energy prices being up, ExxonMobil is looking really healthy again. So just identifying a couple of companies to keep an eye on. One company that made a nice run up, but seems to have stalled now is X, which is US Steel. Certainly bounced off the lows nicely, but now looking like its rally has kind of fizzled. Certainly, those of you are the AMC apes, right? You know, the AMC apes. We had another short squeeze in AMC. It looks like, you know, AMC kind of orchestrates these short squeezes every now and then, but you can see AMC rallied all the way up. And then this is the most recent one, which was of the meme stocks, was Bed Bath & Beyond short squeeze. Stock ran from $5 all the way up to $27. I was just reading an article today about some kid who invested $5 million of his parents' money, turned it into however many millions, I think $110 million on AMC, on Bed Bath & Beyond. Nice to have $5 million to trade with of your parents' money. I don't think many of us fit into that category, but certainly an interesting story. But these short squeezes continue to happen on these meme stocks. Probably not the best thing for a beginning trader to trade, but certainly interesting, things to talk about. And with that all being said, I'm going to jump back to our presentation and wrap things up for this week. So I would like to talk about our last competition of the year. So we have a competition announcement. The dates have been announced, and DAS is teaming up with Nasdaq for our swing trading competition. This is the registration will go from September 5th to October 2nd. And so you got pretty much, if you sign up on September 5th, you can pretty much use your DAS Trader software all the way to October 2nd when the competition starts. Save $50 during early bird registration from September 5th to September 12th. So the earlier you sign up, the more time you get to use the simulator. Also, you save $50. The competition runs for 20 trading days from October 3rd to October 28th. Prizes include 6 months, 9 months, 6 months, and 3 months of the DAS Trader Pro platform. The winner's name is displayed at the Nasdaq Market Site Tower. I will give you a guided tour when you come to New York. You can check out all the rules, and I do suggest you check out all the rules at the onebesttrader.com website. That way you can see all the differences related to a swing trading competition. You guys have asked for it. We have delivered, and I think it's going to be a very, very exciting competition at that. We have our regular updates, which is stay up to tune with everything DAS by signing up for a monthly newsletter and email. Simply fill out the form at the bottom of the webpage at www.dastrader. Subscribe to our YouTube channel, DAS Trader TV, and our newsroom reminders will certainly hit the little bell, and that will give you reminders. Follow us on social media at DAS, everything DAS. So whether it's LinkedIn, Twitter, Facebook, or Instagram, certainly follow us on everything DAS and keep up to date. We do a Tuesday trading tip, a Thursday trading tip. On Monday and Wednesdays, we do market outlooks where we talk a little bit about what's going on in the markets on all of our social media outlets. And we do a bi-weekly blog as well as with all kinds of trading and educational lessons. And we also do, of course, the newsletter every single month. And we have been spot on with our analysis in the newsletter in terms of this market sell-off and some of the reactions to the market and some of the reactions of the Fed to interest rates, et cetera. So it's been, it's been mentioned that a lot of people have found that very helpful. So you should check that out. On that note, everybody, enjoy the rest of your weekend. Enjoy the rest of your summer. We will see you in 2 weeks, and hopefully you sign up for the newsletter and you'll be hearing from us then. All the best, everybody. Bye-bye now.